Hello everyone and welcome to S&P Global Sustainability Matters. I'm your host Mona Nakvi, bringing you the latest in the business, expert insights and cutting-edge solutions on sustainability matters for investment professionals. Today we're going to talk about what has been a very challenging, tumultuous period in the industry and whether or not investors still are interested in sustainable investing and how they're going about it. Joining me today is the PRI's Chief Executive Officer, David Atkin. David, thank you so much for joining us.
Great to be here.
So David, let's start right at the beginning. What is going on in the landscape? Are investors still interested in sustainable investing? What are you hearing from your signatories?
So look, I think we've ridden a wave of momentum around the whole responsible investment thematic. We've seen this bottom-up response from the investor community over the last 15 or 20 years, to the point where if you use the PRI as a proxy, having more than 5,000 signatories representing 120 US trillion, that's about half the institutional capital out there. That tells you that this thematic is something that's resonated with investors and they find it very helpful in the way they think about their own value creation for whichever constituency that they serve. Now clearly we've come to a point where it's very much mainstream, it's not niche anymore, and we're seeing legitimate discussion around the claims that are being made about sustainable investment, ESG, responsible investment, whichever is the lens you want to use. And I think that's quite a healthy thing. It's this is a new part of the industry. This is a new way of thinking about how you make investment decisions, what information you gather, and how you assess risk and opportunity. So we're going through this sort of storming, norming, forming process, and we're now having very healthy debates, I think, about what is our purpose, what are the claims that are being made, having evidence that supports that, and then having, I guess, a regulatory response where we're seeing this top-down architecture being put in place by policymakers as a response to this, this new thematic. But the final thing that I would say is that having done a very comprehensive consultation with our signatories around the globe, and we represent 5,500 signatories in around 90 countries around the world, this thematic remains relevant and important to investors as the day that we started in 2006.
Fantastic. That's great to hear. So sustainable investing, in other words, here to stay, at least for a little bit longer.
Yes.
Fantastic. Well, let's dive into, you talked about risk and opportunities. I'm particularly interested, especially as we are trying to mitigate some of this backlash that continues in certain markets. Is sustainable investing financially material, and how so?
Well, I think the whole point of taking a sustainable finance approach, or sustainable investing approach, is to better assess risk. What we know is that the way in which we think about the balance sheet has changed over the last 30 years. And if we take the S&P 500 Ocean Tomo survey, which has tracked this over the last 30 or 40 yees, in the 1970s, these numbers won't be correct, and you can correct me.
We'll make sure they're at the bottom,
yes.
Don't worry.
When looking at a balance sheet of a S&P 500 company, tangibles made up around 80 or so % of the company's value. And only 20% intangibles. Roll that forward to now, and it's less than 10% is tangibles. So what does that mean? That means that when you look at trying to assess value within a company, you have to think about human capital. You need to think about the environmental footprint. You need to think about the social license to operate, the reputation, the brand, the R&D of the company. All of these things now need different tools to assess value and to assess risk and opportunity. And this is where applying a responsible investment approach means that, and particularly around timeframes, we know that there are externalities that haven't currently hit the balance sheet or are still emerging, that when you use a responsible investment lens, it means you gather information in a more holistic way and are able to assess risk in a more comprehensive way, and then helps you identify where the opportunities are in the future. And certainly if you're a pension fund, which is my background, you're having to think about time over, value creation and time over, many decades. And so then what you're trying to assess in terms of the competitive marketplace that companies have to operate in will change as a result of that different time frame. And we know that the ESG risks emerge in different time frames or in different ways. So I think it's as relevant today, in fact it's more relevant than ever, because we know there are major externalities that are currently coming down the runway that without this lens you won't properly assess, and then you will not be protecting the beneficiaries or the customers that you serve.
That's fascinating, because I suppose in some ways what sustainable investing is trying to do is modernise and equip investors, modernise our financial analytical frameworks and give us the tools and data we need as an investment community to properly assess all manner of risks and opportunities, be they sustainability or otherwise. And I suppose this kind of push for intangible assets is partly part of this feedback mechanism that's making it relevant to the bottom line. But it's very interesting, I know you've got a background in the pension space, and obviously you talked a little bit about the materiality of these different issues having different time frames. What do you say to the short-term investors who are focused heavily on quarterly earnings and short-term frameworks, and the potential materiality window of some of these topics going way beyond that? Is it still relevant to those with a shorter-term view?
Well, I think the answer is yes, although I think the time frame lens makes the ESG sustainable investing lens even more compelling. But if you're, as an investor, not assessing a company's strength of corporate governance, if you're not assessing how it's thinking about its social license to operate, if you're not looking at a company's environmental credentials, then you could very easily see value destroyed under your feet. I mean, the reason why, for example, in Australian context, there was strong interest from the pension industry into the whole ESG space was at the turn of the century, when we saw corporate collapses as a result of governance failures destroy billions of dollars of shareholder value because of poor governance. And so, if you're a short-term investor and you happen to be in one of those periods where you have, one of these crises emerge, and you haven't made any assessment, then you're going to be much more likely to lose on the downside than if you had strong processes or strong analysis of a company's credential about its governance, around the way it thinks about, all of the E, the S, and the G. I think the most important thing here, though, is that when you're assessing where you want to deploy your capital, is to make an assessment about the quality of the management of the company. And our experience as investors is that a company that's understood that it's got a commercial imperative, that it's analysed the competitive marketplace, and that it's looking at these broader thematics about demographic change, about societal change, environmental change, and they've been able to articulate how their strategy is a winning one that's going to navigate those broad externalities or those broad macro issues. We always found testing the management's ability to articulate their value creation through all of that was what we were looking for from an investor perspective. And I think that's as relevant as if you're a short-term, medium-term or a long-term investor.
Absolutely. I like to think about it as a sort of monetary game of hot potato, right? You just don't know where the buck's going to stop. And in many ways, management quality and good governance is key to the adaptability of these companies. And you don't know necessarily where these risks are when they're going to take place. And so it's about being prepared. This is interesting, because if it is so financially material, why do you think there's been so much politicization and anti-ESG and sustainable investing sentiment in certain regions?
So in a way, what we've seen is it's come from sort of two ends of the spectrum. So on the one point, now that it's a mainstream thematic, we're seeing this concern about greenwashing. Totally legitimate. Although on the greenwashing side, I think we need to unpick that a little bit. I think there's a difference between a strategy that's failed with a strategy that's been misrepresented. Absolutely. Right? So the disclosure piece and the evidencing that we believe these things, we've got this strategy and we're doing these things. If you've misrepresented your product, that requires a fairly, a strong response from the regulators. That's different from a strategy failing, and often these things get conflated. On the other side of this debate, you've got, this sort of ideological, anti-ESG. Unfortunately, it's become politicised. In a way, I think it's a signal of the success of the sustainable investing approach that we're seeing this response from parts of the fossil fuel industry.
Yes.
That's funding some of this activity, and it's now flowing through to some of the Republican fundraising efforts for particular candidates. But at the end of the day, I think, notwithstanding that, it's completely reasonable that that this should be a debate that's had. So I've got no problems about that, but you want it to be evidence-based and based on the facts. What I would also say is that when we're not seeing what's occurring in the US flow through into other political debates. It's at the margin if it is. So this is very much a US-specific challenge. And I would say that from an investor's perspective, notwithstanding that there's a legitimate or a debate that's occurring, you either believe these things are material or you don't. Right? And if you believe that these are material, then you can't stop the efforts, the fiduciary responsibility to assess these risks, to see whether they're material, and then incorporate that in your decision making. Frankly, it's a dangerous pathway if fiduciaries say, well, because there's a political storm over here, but I believe these things, I'm no longer going to be using this lens. I think opens the fiduciary up to risk, to litigation risk.
Yeah, absolutely.
So, but if what this debate does is that it sorts out those who are only there for the marketing purposes compared to those who had true beliefs, that's not an unhealthy thing, because then, frankly, those people shouldn't have been in this space in the first place.
That's a very good point. Actually, you talked about greenwashing. I'd love to dig into that a little bit more. We certainly hear much of the criticism around greenwashing, and as you correctly point out, if an investment product or fund is deliberately overinflating the sustainability outcomes, then that definitely should be addressed by the regulators. I don't think anybody would argue with that. But what do you have to say about some of the other criticisms? Do you think all critiques of greenwashing are entirely justified and valid, or is sometimes around the margin there a little bit confusion and work to do around education?
Absolutely. I mean, I think the first point to make is that the climate issue is an existential threat, if you believe the science, and investors are developing the toolkit to deal with climate change, incorporating it into the way in which they think about risk and the way they think about portfolio construction and the strategies that they run. What they're finding very challenging is that they don't have all of the domain expertise to be able to properly understand the science, and then how that then, what the consequences of that flowing through to investment strategy. So it's unsurprising that we're in an uncomfortable period where we don't have clarity about all the tools. We don't have standardised information that enables kind of a compare and contrast ability. But it is, at the same time, what we're seeing is legitimate concerns from civil society about is the industry doing enough addressing climate change? And I do think the investment community has got a really critical role to play in education. But I mean, I would say, for example, we've had the divestment debate, for example, is a bit of it's a really bit of a non-starter, because if you're an investor and you divest out of fossil fuels, but you just sell those assets to someone who cares less, have you really decarbonised the economy? No. Have you really helped with the problem? Well, you've solved your public PR exercise, but you actually haven't addressed the carbon problem. So we've got to find ways in which we decarbonise the economy, and the role the investors have to play is a critical one in that. And part of that is also about educating civil society about strategies that are legitimate and which ones are not.
Absolutely. So, I mean, even if we could all get everybody on the same page and to the same level of technical prowess around these very nuanced and complex issues, I still wonder, though, is part of the greenwashing challenge partly because we lack a universal framework or approach? I mean, is that indeed even something we should be striving for?
Oh, well, I think on something like climate change, we know what the number is. I mean, there is a carbon budget.
Yes.
So we can work back from that. The problem we've had is that we've not had agreed, standards set around how you address the carbon problem. I think the promising thing, though, is that we are seeing emerging frameworks now consolidated. And I think that through the TCFD reporting, through the establishment of ISSB, we are going to find consistent ways around the globe that companies are required to describe their sustainability risks, and investors are going to be able to make judgments. And I think that's a really important building block, because that's what we've not had that. So I think, we need to be in a hurry because we don't have that much time. But I actually I feel much more positive than, say, if you asked me this question 2 or 3 years ago, where it was alphabet soup, everyone was frustrated, and we didn't have a sense of direction. I think we do now.
You're right to point out, David, that we have a number with respect to climate and carbon, but we know that's not the only issue. I mean, just transition is a huge topic. And as you know, there are inherent trade-offs and very difficult choices that the global economy needs to make on the whole, and for investors individually as they construct their own portfolios and strategies. I mean, how do you advise, the signatories, or how do you work with the investors in helping them overcome like these interconnected complexities and help them navigate a one true path, if there is even one?
Yeah. So you are absolutely right. The interconnectedness of if you want to deal with the climate issue, you have to deal with the S piece, the just transition. We also know that you have to also address the nature piece, the biodiversity piece, and you could keep going on. So I think where we need to go is integrated thinking. We need to be able to use different areas of domain expertise to build the information that we then put together, and we understand. This is where there are going to be trade-offs. You cannot address all of these things all at once, and investors are going to have to prioritise. Governments are going to have to prioritise. But what I would say, for example, is that we know you can't solve the climate issue unless you address the emerging markets north-south question. We need more capital deployed in emerging markets. It's also not fair to expect emerging markets, or the South as a proxy, to be doing the same heavy lifting, who've not done they're not the economies that have created the carbon problem. So, you have to allow each of these economies, I think, the scope to work at different paces. But I would say that from an investment community perspective and the role of the PRI, we have a responsibility to foster the emerging markets, capital markets, and to create bridges so that institutional investors in developed markets can find solutions in emerging markets, because unless those countries have the same level of investment, then we're only getting half the story, if that, frankly, in terms of going to that final number that we need to get to in terms of the carbon budget.
Absolutely. And, I'm pleased to hear you talk about some of the global geopolitical kind of dynamics at play here, because at the end of the day, we are talking about some big, complex global challenges that really do require coordination. And speaking of global challenges, we know that the UN Sustainable Development Goals framework has been an incredible tool in helping to guide nation states towards the achievement of certain real-world outcomes. But in your view, in your investment hat, how can investors take the SDGs, or perhaps another framework, to work towards the achievement of real-world impact? Is it even an appropriate lens for the investment community to go along that journey?
Look, so the answer is yes. But it is also important to point out that the SDGs were never developed to be investable.
Right.
The positive thing about the SDGs, though, is that governments around the world have agreed to what are the sustainable development goals that need to be addressed to have to enable a global world to operate from a sustainable perspective. But it is possible to translate the SDGs into investable opportunities. Not all of them, and we've seen different approaches to this. But I can say for myself, from the fund that I used to run in Australia, that we found it very helpful to use key SDGs that lined up with our priorities, and then use those SDGs as a stretch target when we were thinking about investment opportunities. The other thing that I would say is that the SDGs are coming under review by the UN later on this year, and I think that's going to be a really important opportunity to sort of take the feedback of over the last 10 years of experience, but also to take an investor perspective so that we can better establish those SDGs as investable roadmaps for those who want to go down that path. So I mean, and I think that it's a good, this year the UN will go through that process, and so next year I think we will see some sort of SDG version 2 come out that will be very exciting.
That will be very exciting indeed. So, I mean, the UN is one of many standard setters and bodies that is trying to push more global equality and global sustainable outcomes. But, talk to me a little bit about the global landscape, not just for bodies like the UN, but the PRI and other standard groups, and the role of private finance versus public policy in all of this, because presumably it's not going to be just the job of investors alone.
Yeah. So the first thing that I would say is that the positive in the last 2 or 3 years is that we've seen a recognition that the private sector and the investment community in particular have got a really important role to play in addressing climate change. That hasn't been the case for many years. We were sort of knocking on the door in a way. We need to make sure, though, that it hasn't flipped too much, that investors are now seen to be, well, actually, it's up to the investors to solve this. That's not realistic. And we need to see more collaboration between governments around the world and, I guess from the private sector and the investor side, from where I sit, identify to a level of granularity what the policy framework needs to be in place to get private capital to work. I mean, I think just transition plans from countries and companies and investors are, inevitably becoming mandatory. But we need another level of granularity, and we need to see governments in countries talk about what the transition plan is for transport, or for agriculture, or whichever the key economies of the key industries of their economy. And then we need to see a pipeline of projects that are investable, that are put out onto the market in a competitive sense, but then investors can bid for. And I think the project pipeline is just not there to the degree that it needs to be to make the transition. So I think this is where the heavy lifting needs to go in the next phase of this transition piece.
Well, that's a really helpful guiding North Star for the global agenda in general. But if you had to give just one single piece of advice to an investor that's just beginning on their sustainability journey, what would you say to them? How can they come to terms with all of this and actually help contribute to the achievement of some of these goals?
Well, I would say this, but I would say join the PRI, join the principles, adopt the principles, the 6 principles of the PRI, because if you do that, we have a range of tools and programs of work that helps accelerate your maturity as a responsible investor. And so you'll more quickly get to the place you want to be if you become a member of the PRI and you take the learnings of other signatories and get to a point where you're better assessing risk and opportunity, but then also beginning to think about how you can use your investment programs to create really positive societal outcomes, but on the basis of delivering the investment returns from a fiduciary point of view. And they're perfectly complementary if you think about this in a more holistic way.
Well, that's really compelling, wonderful guidance. Thank you so much, David, for sharing all of your wisdom with us today. To learn more about our sustainability insights, check out www.spglobal.com/ESG.